Thank you for having me on again to just present an outlook for the second half of 2021. And I'm simply going to title this, Where Do We Go From Here? We were up 16% for 2020, and that was not from the lows. That was from the end of 2019. If you counted it up from the lows, we're not even going there. And so far, we're already up 14% for the first half of 2021. But can we even compare the current monetary environment and technical environment to the previous 100 years? So I'm going to throw a bunch of ideas, my theme for the second half of the year, and perhaps some other types of industries or sectors that we can look at. And let's just get going here. I start out always with my analysis with sentiment, because to me, sentiment is one indication of how much money there still is on the sidelines. And of course, there's been this huge awareness about how the increase in the monetary base due to the Fed actions, but also on a global scale, has been a boost to financial assets. You could call it simply financial asset inflation. But I have a chart here showing the AAII. That's my favorite sentiment thing to follow. And this does give good comparisons to the past as to what happened at market tops. And you can see historically that once you start to push up above this 50% threshold, I've never quite seen it get too far above 60, but 50 to 55, you have to start to pull in your horns a little bit and say an awful lot of money has been invested at this point in the game. Now, as an aside, you can easily see for the year of 2020, despite that ginormous market rally we had, this community refused to get bullish. And if you compare the community for this particular sentiment survey versus Investors Intelligence or some of those others well-known ones, these tend to be a slightly older, more mature market, a little bit better capitalized group of people. And so I put a bit more value into it, even though it's a survey that's done in sort of a randomly generated means. So you can see that nobody was bullish during 2020 until finally in the very middle of the fourth quarter, when we broke out to new highs, they started to join the party. And it has still been quite a party since. As I mentioned, just for the first half of 2021, we're up 14%, and that's basis the S&Ps. So here we are pushing up there, but we aren't quite to historic levels yet. I'm not sure how much more it'll take to get there, but that's something just to be a little bit aware of. Once we do hit these very overbought, fully invested type of readings, it does not imply a bear market, but it could simply mean that we have a very broad, choppy, swinging trading range for most of the second half of 2020. So that's my outlook. The other thing I like to look at for a bit shorter term timing indication is the simple put call ratio of the CBOE. And this red line that you see is a 5-day simple moving average. So it helps smooth out the data a bit. Now, two things are quite notable with this chart. You have a regular period cyclicality of the highs in this data and the lows in this data. So that makes it very useful for us. You can also see that the best buying opportunities come when this red line is at the upper end of its range. That tends to be a better time to at least commit funds for anywhere from 8 to 12 weeks. And that's when that line is high. Now, just because the line is low and indicating that there's been a lot of call buying, it doesn't necessarily imply that a sell-off is coming, but it increases the likelihood of that. So obviously, if you look at September last year, it just signaled that we were due for a little bit better correction. Now, if I look over on the right side of the chart, we are coming off more of an opportunity to start raising your stops, not necessarily the ideal time to commit funds. So when we go through and we look at possible investment ideas and different sectors for the second half of 2021, do that with this shorter term timing in mind, that because we're well up doesn't imply a bear market, but we want to be a little bit more sensitive to the times that we are going to commit funds for a little bit longer time horizon. Now, with that said, there are always stocks like this. And if you've been following Costco and Walmart and Target, they have been what I call well behaved. That means not too much volatility, a steady trend. And just to prove my point, I put up a monthly chart. Now, before you start to see any signs of concern with well behaved data like this, we would expect to see a longer trading range at the top where you would get distribution. So there's lots of stocks out there where we're not seeing the distribution at all. The data is still being well behaved. You want to own these in your portfolio. But with that said, that would be something to keep an eye out on. So this is for the stocks that have well behaved data, steady uptrends, and not too much volatility. No big gaps, no big dislocations in the data. That would be noisy data, and that's a little bit more challenging to work with, even though at this point in the game, that can also be where there are more opportunities, ironically. So let's go down and start looking at some different ideas and themes. And even though it got quite popular this last quarter, the theme of energy, I do believe that there are sectors out there which have super nice bases and have not gotten marked up yet. And this would be my number one choice. First, solar. Um, it's it's just starting to come to life, and you can start to see the increase in the upside volume here as it breaks away. And the nice thing about this particular company is I do like Sunrun. That's another solar company, but right now bulk of their product is made in a district in China that's under scrutiny from the administration, and you don't want any political worms with the supply chain for your primary product. So I would pick this First Solar over the Sunrun. And if we go back and we start to step out to the weekly time frame, how pretty is this chart formation? We had quite the trend up into the end of the year, and I think it was pretty well publicized that the Biden administration was going to concentrate on alternative energy sources, so it might have gotten a little bit ahead of itself. This is pretty typical that you see the volume divergences here that lead to that little bit of a top. So in technical analysis, we had a pretty rising wedge here with 1, 2, 3 pushes up. And now we have done my favorite correction, this ABC consolidation with super light volume down here on the C leg. So this is really nice when you see this on a weekly chart. It's actually pretty rare that you see such perfect technical chart and cycles there. there. So I do believe this has pretty good potential to eventually take out this high. So it could be one of those instances that hasn't already been marked up 20, 30, 40% on the year. So that's First Solar. So in addition to the solar stocks, I trade a lot of the commodity futures, and this nat gas really is starting to come to life. And so I put back a long-term historical data so that you can see the upside potential. And this is during the period before we had the fracking, but it's like past when we had those crazy moves in nat gas from the hurricanes that would hit the Gulf. That's not an issue anymore with this particular commodity. So what I really like about this is twofold. You had this nice chart formation here, 1, 2, 3, 4, a 4-point triangle, which is leading to another leg up as expected. You have gap areas up here. And if we look at the contracts for nat gas that are out a year from now, they are really hot to trot. So that says that there's going to be increased demand looking out at least a year from now. So with this in mind, again, gas was a sleeper there for a good 2, 3 years. With this in mind, let's look at this particular Alerian fund. It tracks an index. Okay, there is this Alerian Midstream Energy Select Index. Now, this chart in and of itself doesn't look that exciting, but it pays a dividend, and it pays a pretty nice dividend. And that's kind of a scarcity these days. So these are the top 10 holdings in that. I've had a nice position in this for quite a while, and the interest of full disclosure. So I don't want to, you know, um, I feel like I did my research early on, but I feel this has so much more potential to the upside. So they concentrate on production, pipelines, infrastructure, all these types of things for nat gas. And I'm sure as everybody in California is finding out, solar is not the answer to all your needs, especially overnight when the sun is not shining. It is not enough to drive those air conditioners that they need right now. So we need to look at all different sources. So this is a pretty good one to follow. And two of my favorite subsets of this company, OKE, actually I've got the heading on this chart a little bit mixed up. It's pipelines and processing. This is ET Energy. That's the other one. Here we go. Okay. And then, whoops, just to go down, I have a long-term weekly chart, which has gotten lost in the shuffle, but it shows plenty of upside before we actually hit new highs in this. So on this same theme of inflation, and there is no doubt that we have a tremendous amount of money flowing through the system, a tremendous amount of increase in demand, and that's a huge driver that is not going to go away. So this transient nonsense is exactly that. It's nonsense. It's a fact that the demand is going to increase all across the board for everything: housing, appliances, metal, and in particular energy. So let's just go down and look at some of the metals here. I like the industrial metals a lot more than the precious metals. Copper is the most widely used commodity in the world in the most diverse group of products. Now, it got a little bit ahead of itself just simply because China, which uses more than 50% of of the world's supply of copper, had been stockpiling it and building up quite a nifty little stash. But with that said, when you look at our technical indicators down here at the bottom, and you see this get so overbought, that does not mean that it's a top. It simply means that you had a correction. Now, keep in mind, this is a continuous contract and it is weekly data. So I wanted to show you that it took 10 years for copper just to get back to that previous all-time high, which we just took out on this last swing. Very typical for a market, the first time it retests a previous major high, that you do see some selling and consolidation coming in. And with that said, I don't see this having pulled back too much in the light of, I never look at this big slip on ice here. This was the aberration. Personally, when I do my analysis, I just chop that off and pretend that that didn't exist because it was a black swan event. So it wasn't natural supply demand factors. So we really just accelerated out of this base, and this is a big leg up, and now we've had a pretty healthy correction. It doesn't mean that it's going to go right back up here, but the reason I'm introducing copper is because it's a class of metals that includes aluminum. And all of these are in hot demand. So aluminum also had a nice uptrend. And look at this gorgeous consolidation that you've had. It's really marked a lot of time without giving up too much price. And that's super important. You know, it was Gann that said price equals time, that after you have these big moves to the upside, you have to consolidate sort of to that 90-degree angle. And I just love the fact that you've been selling down or consolidating now for 4 months. And really, I love these low priced stocks. You know, they're nice because you can actually buy the stock. You don't have to buy options, as would be the case on some of those quadruple digit ones. So this also I thought looked gorgeous, and it's just coming to life just at the end of last week, as well as aluminum. Now let's go down and just take a pause in our technical charts. And I just want to add a comment here that how difficult it is for us technicians to compare any condition that we're in right now to the previous decades, let alone the previous 100 years, because the increase in M1, which is the rawest, basic, most, ready money available, is something that I don't think any of us can put our hands around, nor the ramifications of this. And so that's why we see so much liquidity out there, cash on the sidelines. Now, nothing goes straight up, everything has cycles, but there's so much cash on the sidelines. That's why you're seeing these insane numbers for these reverse overnight repos, which are an operation that reflects just dynamics that we have never before seen in history. So, with that said, when we look at stocks and industries, it's very difficult to refrain from from displaying some type of common sense and saying, a PE ratio of 33, that might be a little rich, okay? Because you have a lot of PE ratios which are much higher than that. But we can't do that as technicians. We can't say something's priced too high or something's priced too low, especially when it comes to this area of financial asset inflation, which could just be beginning if you were to take this data on the right side of the chart. We don't know. So with that said, we always want to monitor where we are going to risk to. What would be a serious breakdown when we continue to look at charts? Now, in terms of technology, everybody knows technology's been a fabulous investment. Here is one of my favorite stocks for two reasons. First of all, it has not gone parabolic. Second of all, my son-in-law, who's an IP attorney, got me into watching this case that was settled, actually not in Oracle's favor. If it had been settled in their favor, it would have meant tens and tens of billions of dollars for infringement on an operating system for the smartphones. And I'm not going to get into the details, but suffice to say, the settlement was right back in here. And when that when Oracle lost that case, which could have been just serious, the largest amount of billions of dollars of settlements ever in history, guess what the stock did? It rallied and it continued to rally and it's still rallying. So it had this lovely grinder creeper trend up, a few little shakeouts to the downside, a big gap down here, but this big gap down still put in a higher low and it's coming to life again. So I just love it when you see a stock that is moving positively when there were unfavorable settlements or potentially bad news. So I've been watching the action in this very closely, and I don't think it has hit that point yet where it's gone parabolic. So I see lots of upside potential in that stock as well as Cisco. Now, this is a slightly different case because it has not participated much in the last 3 months when a lot of other markets were really catching a bid. So there's two sides to this coin. You can say on one hand, this stock is not, it's flying under everybody's radar, okay? It's held up just fine. There hasn't been any selling pressure. It's not the relative strength leader, group when you look back. But with that said, it's made still a steady pattern of higher highs and higher lows. So at this point in the game, because we have had good rallies, I'm looking for candidates that have not yet seen that explosive parabolic move. So this would fit the bill on that. And look how nice this little MACD is right down here, having corrected all the way back down from this high made in April. Here is another lovely technical pattern that I like looking for, and that is where you see correction in the momentum oscillators and the technical indicators, but price still continues to make higher highs and higher lows. That is a sign of positive consolidation, and you want to be on board these as these indicators turn back up. And of course, the indicators are generated by the price. So that's nothing more than saying jump on board when the price starts to rally back up. Now, this is a different category, drug stocks, and it's only because I've seen in the last couple weeks some pretty good buying come into these. And again, they're one of those groups that isn't like the Costco and some of these other technologies that have just had terrific runs. Okay, but this has been pretty well bid. And you can see how close we are to all-time new highs. So I would really like to see how this stock acts if it can start making new highs on the year. So this is an interesting chart because anytime I look at the daily charts, I have to look at the weekly charts and I have to look back at least 10 years. So this is another example of recent data on the weekly charts that's relatively well behaved, a little bit of a grinder here. So it's got potential to ramp up. It's got potential to explode out of this base, but on the other hand, we still must always have our risk points. Well, if this doesn't go, then if it comes back down below the 60 level here, this could have been distribution. So I like it. It's got upside potential, but at this point in the game, just know where you would not want to see something go, because it hasn't really done too much over the last 5 or 6 or 7 years. So it has potential, and I'll leave it at that. Now, this stock, Pfizer, another one in that drug category there, obviously has digested all this vaccine volatility here over on the left-hand side of the chart. And there was quite a bit of little funkiness going here when you saw the chairman of the company dump like a huge amount of his stock. That didn't exactly generate a vote of confidence for this particular case in time here. But with that said, look how it has consolidated here now, built a nice sideways line. So one of those in the category you see, I will say, has potential. We just want to see some increase in volume and steady push up, and we haven't come anywhere close to getting overbought. So these aren't hot stocks. These are a little bit lower beta. And at this point in the game, when you've been at the later stages in a market rally, I find it better to jump down to slightly lower beta candidates, because they can, the high beta ones, the ones that will move twice as much as the S&Ps, will come back and bite you in the butt when there is a correction down, and there will be, probably not too significant, but it wouldn't be unlikely that sometime in the next 6 months we see a 6 to 8% correction from wherever the peak may be. Now, Union Pacific, again, it's not an exciting stock. It's just got a steady business model. And this is actually a weekly chart, weekly data, another candidate that didn't go parabolic yet, but has a real steady bid and is super close to new all-time highs. And I wanted to show you another lovely feature of StockCharts, and that is that you can put up seasonal charts on stocks. So I did that with this particular one. And the reason that I had that stock chart up was because this good old railroad was up 83% of the time the last 6 years, and 80% in August. And these are normally crummy months, okay? So we come into a period here in September. Well, you can see it didn't do so well in October, that's for sure. But you have to start looking at the industries and groups that didn't do as well as we go into that month of September, okay? It's called the fall swoon, but this one was a stellar performer, up each September for the last 6 years. So that's a good resource that you can go and look at the seasonality of a stock. Now, lastly, let's just see this small cap index here. This is where a lot of technicians have been commenting on these divergences in the market breadth. Not only that, but certain volume indicators. And these are very important just because we have fewer shares now that have been leading and controlling a lot of the volume. So let's drill down and look at these small caps, because this can be the tail that wags the dog. All right. So it does not look like a very inspiring chart going back all year. year long. And that's another reason why these breadth divergences have appeared so prominent, because any day where you see breadth down but the S&P's up, it's due to this small cap. The small caps are the broad market. And in the past, the Army is very important. The generals can't march too far ahead until you get that Army backing them. So this Army is barely doing a job of backing up these generals. But with that said, let's just step out and look a bit higher time frame here. I looked at both the monthlies and then we'll look at the weeklies. If we put it into this type of context and how far we rallied in 2020, and the fact that you had all this rotation back into some of these Zoom and Amazon and FANG stocks that have made their tops at the end of third quarter last year, this is actually holding its own just in light of the steadiness of this long-term trend. Okay, so I don't think that's necessarily negative. And now, if we go and we look at the weekly charts, this is sort of that tenuous little area of some of the other stocks that I was showing you. They're not relative strength leaders, but they have potential, because we should start to see an increasing amount of rotation at this stage of the game, where shares that are well marked up get sold to purchase other stocks that might have more opportunity. So in the later stages of a bull market, momentum stops becoming the driving factor, the momentum stocks and the relative strength, and you can start buying the things that haven't moved. That's Gary Anderson's work, the Janus factor, if you want to research that. So this has a nice sideways line. There is potential here. If this does break out of this nice little base, it can carry our market for at least another month or two until you start to see those sentiment readings become a little bit more overbought. All right, so that's what I have to say. Keep an eye on those sentiment readings. They're not the ideal buying time, so you need to be a little bit more selective, careful about chasing at this point in the game. Do expect that we will have at least 2 more instances before the year end of where we have those high put call ratios that we saw in the very beginning that provide less risk on those buying opportunities. That would be the cyclical nature of these swings from overbought to oversold in the sentiment reading. So we should have 2 more good buying opportunities before year end. And the only caveat is that those buying opportunities could come after we've been marked up to higher levels. So it doesn't mean that you're going to get a sell-off from this point. We could easily rally up another 3 or 4 percentage points and then have one of those, hopefully, gentle correction consolidations to the downside, because as you remember, there's still a lot of liquidity out there. So trade your hearts out over the second half of the quarter, and I hope that you get a great representation of all different types of sectors from the wonderful lineup of speakers that StockCharts has put together for their mid-year perspective. Thank you for having me on to give my 2 cents.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.